Look at our stock index head and shoulders patterns also. And one in particular occurred in the US 500 or the CFD or the S&P 500 market. It occurred on the 30-minute chart on August 8th. And you can see that this market, this was almost a textbook head and shoulders pattern. Even the clarity over here was picked up as a 10, which is that maximum amount. So this could be a clue that perhaps you should initiate your searches for good head and shoulders patterns with maximum 10-bar search. Now when you work with the filters, you have to remember that the lower the number, the tendency is that the search criteria is a little bit loose, so you may get more samples or more opportunities. And as you move that slide bar up to, say, 10, which is a very strong clarity pattern in this particular case, your number of completed patterns will become fewer, so you'll have less selection. So there's a give and take involved with trading, and what you need to know is that you want to make sure you have just the right amount of opportunities to make yourself a successful trader. If you have too few opportunities, then you always feel that you have to catch the big move. And if you have too many opportunities, then you feel that you're over trading and maybe spending a little bit too much money on slippage and commissions. So you have to find a filter that gives you enough trading opportunities to make yourself profitable and also not wear you out from trading too often. And that's, again, one of the beauty parts of finding the optimal search criteria that you're looking for. Okay, we'll go back to our PowerPoint slide right now, and we'll talk about some of the trading rules that are involved in working with the head and shoulders pattern. Now, the basic entry rule for a trade based on this chart pattern is to enter the short trade immediately after the breakdown of the neckline. Okay, now the beauty part about AutoChartist is that when we do get that break of the neckline, an alert's going to go off. Either you'll have a visual alert, which is an orange marking or an orange dot, which I'll show you in a bit, or you get an audio sound that sets it off. And as I've said at previous webinars, that once you put your homework and your time in and study these patterns and become comfortable with the program and set your filters to what you want to find, when those alerts come up, you should not spend too much time studying what's coming up on that particular chart. You should be in a reactive mode at that point, so that when you hear that alert go off or you flip to that screen that shows you that a head and shoulders pattern has just completed, then you want to be able to be in a position to take action at that particular time. Because the way the markets work is, and with this particular pattern, it takes a long time to form a shoulder, head, and another shoulder. So the more information the market reveals to a trader, and the more confidence they have in the move, then what happens is there's a cost involved in it. If you keep waiting for further confirmation of a particular pattern and the market begins to run away, the thing that stays the same is your exit, or where you're wrong on the pattern. What changes is your entry. And so the farther your entry gets away from your exit, the more it's going to cost you to trade a particular pattern. So that's why it's important to work to get in a pattern immediately when it's signaled on the alerts, so that your cost of taking that particular pattern is less than, say, somebody who hesitates maybe 15 minutes and waits for another confirmation and another confirmation. Those types of traders waiting for so many confirmations basically miss a lot of moves, because not everything is perfect. No pattern's perfect. So the thing is, when you hear that alert go off, know that it means that there's been a breakout of the neckline and that you should be ready to trade the pattern. The other thing you want to know about trading is that you should have to set your stop loss above the neckline. Like any of these momentum patterns that we trade in AutoChartist, whether it's a triangle or a channel or this neckline pattern, you have to know that most of them are driven by volatility and momentum, so that when a market breaks through a particular point, that you want that momentum to continue. So as they say, like in physics, a trend in motion is likely to continue in motion. So when you get that breakout to the downside, you already know that that means the trend has changed to down, and that you want to see other traders pile in on that breakout, and you want to ride the move along with those other traders. So as I mentioned before, when you're forming the the right shoulder of this head and shoulders pattern, volume is distinctly lower, okay? But as you begin to break out to the downside, your volume will begin to pick up. That's what you want to see. You want to see volume and volatility pick up as the market begins to break out to the downside. And that's pretty much a universal statement, as I said, regarding triangles and channels and other breakout patterns, is you want to have volume on your side and you want to have momentum on your side. If the market breaks out and it hesitates at all, that's usually a sign that there isn't that big trader or that big short in there to push it down. So that's the first warning sign that maybe you should shore up the stop. And another thing that's good about this pattern is that I typically trade knowing my exit first. That solves all the mental problems I may have later when I'm in a move that's working against me. So I go from exit to entry. So once I know where my exit is, then I search for my entry price. Okay? A lot of times you'll find traders seeking out entries, and then once they get in the move, they're looking for an exit. And it becomes more difficult because your emotions are involved at that point, and you're feeling the heat of a particular move moving against you. So what's good about this pattern is I already know where the neckline has been formed, and I already know where the shoulder has been formed. So they give me areas ahead of time that I can exit this trade if I'm wrong. Okay? And again, I just want to warn you that with any of these breakout strategies, they do tend to get a little bit risky because there's volatility involved. And I warn you, you should always use stops when you're trading these patterns. The other thing you want to know about this particular chart pattern is when you're selling weakness on a breakout, is it's considered to be what I call an aggressive type strategy. And that's because anytime you're selling weakness or taking out bids, you face a possibility of a whipsaw back up. But the reward is there because if you hit the trade right where a breakdown is triggered, and that's what this pattern does, is it helps identify where the trigger point is. If you hit it right and the break is triggered, oftentimes you get that acceleration to the upside where you're hitting not only sell stops, but you're also hitting new shorts. So there's a trade-off there. If you want to be aggressive, you sell weakness, and you can be rewarded. There's also ways to trade where you can be a passive seller, that I'll get into in a minute. So when although it's aggressive on the initial entry, once you see a volume confirmation come in, as I said before, and momentum begin to pick up, then that's going to give you confidence that the market is poised to continue to move lower. Now, AutoChartist will identify the pattern for you, but it's not a trading system. So if you want to use it with another tool that you have, perhaps an ATR or some other volatility indicator to let you know that there's expansion taking place, by all means, go ahead and do that. When we have AutoChartist applied on an MT4 platform, sometimes we're able to add these volatility indicators on the chart to help us see that during the breakdown or the confirmation of the head and shoulders pattern, we can start to see that volatility is expanding. And that gives you, again, a confidence that the pattern's working in your favor. One thing you should also note with your trading rules is if you see volume confirmation and price stops around the highs of the left shoulder, then you can enter the short side. That's what I meant by selling, being a passive seller. The first comment here about being aggressive, that's selling into bids. That's selling weakness. The second type of trade is where you let the market go through and confirm or complete the pattern, but then you wait for a retracement back up to the upside before getting in the market. That's, as I said, that is one's a passive way of trading and one's an aggressive way of trading. So if you look at this particular chart, when you break the neckline, you can play for this particular thrust down when there's heavy momentum, and you're likely to get it. Another way to trade, and more passively, is to let the market follow through and then wait for a retracement back up. But in either case, your stop loss is above this shoulder. Okay? Now, there's a trade-off there. When you're selling weakness, obviously the distance between this entry and this exit is wide. But if you use money management and position size yourself, it's not. You can risk the same amount of money with this particular down move, and also with this particular selling action. So again, money management is about keeping the dollar risk equal. So although the stop loss in terms of price level looks bigger